Meantime, our next guest says people have been too negative on the markets of late and that things are bottoming out. Joining us right now ahead of the Monday morning open is Lakos. He is the chief U.S. strategist and global head of quantitative research at JPMorgan. Good morning to you. It does look like the market's going to open lower this morning. Some worried about what earnings are going to look like, despite some great earnings reports last week by the banks. Where do you stand?
Yes, look, the market has had a lot to digest over the course of the last month or two. A lot of moving variables, certainly more than, let's say, at the beginning of the year. But we still think that the broader backdrop remains fundamentally pretty well supported. I think earnings generally probably will be more mixed than what we originally expected, but the threshold has also been lowered a decent amount. When you look at a lot of the stocks that are facing supply chain, inventory sort of sensitivities and issues, they've come off a lot. So I think the bar is also lower. So obviously, a lot of focus will be on what are they saying about demand? Are they seeing just delay or destruction? A lot of focus on, are they seeing and when do they perhaps, expect to see some easing in some of these, supply chain related issues? But I think generally, I think risk reward wise, we're still in a pretty decent spot, just given where expectations have gone.
How much are you focused, though, on rates? Because as we've seen, there's been a creep up. And that may be a signal here.
Yes, look, rates, I think, broadly, not so much a worry, and certainly not at the current level. I think when you sort of dissect the market by sector, by style, by theme, I think, there is some worry, basically. So what I'm saying is you have a lot of long duration type stocks within the U.S. that are sensitive to what rates are doing. And so, high multiple growth stocks, yes, are sensitive. So if rates do continue to move higher, which is our view, then you will likely continue to see a rotation from higher multiple into sort of more of these cyclically inflation beneficiary type themes. And so that's where I think the worry is. So more from a rotation point, not a worry, but that's where I think you can see sensitivities. But I think broadly speaking, market, I think should be able to digest.
But in terms of equities, and maybe more specifically in terms of earnings, how much is it going to be that these companies are not going to hit their earnings expectations, or is it going to be the color around how companies see the future, which is higher energy costs, potential inflation issues, and the like?
I think it's more of the latter. I think all the focus will really be what are companies saying for the quarters to come, 2022. How temporary are some of these, call it, impacts, right? That's where I think the focus will be.
And your sense is temporary. You think supply chain wise, some of these energy issues we're having on the supply side for those folks, that's all transitory?
Look, I think, we still live in a world of capitalism, and I think sooner or later these issues will get resolved. It might take some time, but I would argue that in 22 you will likely see things ease on the supply chain side. Now, commodity imbalances on the flip side, where we're also seeing inflation, that I'm not so sure is going to get resolved this quickly. So I think there is, not on all fronts. I think, as far as corporate world is concerned, demand, I think, remains good. We're just seeing a delay. I think pricing power remains good. Margins still relatively healthy. I think these supply chain issues ease. But on the commodity side, that's something that we need to continue to monitor, because there we could continue to see upward pressure in terms of prices.
Shepard Smith here. Thanks for watching CNBC on YouTube.